it's really great, given what's going on out in the world, going on at the moment in the world, to see so many of you here. It's also very pleasing to see a number of early adopters to Kuber here, and some people who are engaged but are finding out more before they actually try us for real. Early adoption is a challenge for anyone, but hopefully, as I explain, as I go through my little spiel, why Kuber is the best place to be an early adopter in terms of a platform for EIS, BPR, CDEIS, and potentially VCT going forward. My name is Piers Den, and I'm the Sales Director for Kuber. I joined just over a month ago now. My background is mutual fund based, and I had the pleasure of working with Fidelity when they introduced Funds Network, of working for Gartmore, as was Threadneedle when they decided to formulate co-funds in direct competition, and generally working with distributors as they sought to find rhyme or reason for this new aggregating model that is platforms. I joined Kuber because I firmly believe that it is the right platform to achieve the same result for the EIS, BPR, CDEIS and potentially VCT market. I believe that it will provide greater choice. I believe that it will provide simple administration, easier reporting, non-opinionated due diligence, simpler, cleaner, more transparent pricing for you and your clients. So there's a spiel on Kuber, and our objective today is to provide tax planning examples supported by 2 investment managers' product solutions that enable you as advisors to take back to your clients to offer additional and potentially enhanced advice. I'm delighted to introduce Sean Burrows, a colleague of mine, who will run through each of the tax planning examples. The first case study on alternative to pensions will be followed by a presentation by Martin Sherwood from Enterprise Investment Partners. Martin. The second on capital gains tax planning, which will be followed by a presentation by Keelan Doyle from Simban. An hour has been allocated for each, and this workshop has been designed hopefully to be interactive. The more we interact, hopefully the more we learn. So please, if something is not clear, or you have a thought about other applications, or you wish to delve further into more detail, please don't hesitate to speak up. On that note, hand over to Sean. Thank you.
So, good morning, everybody. Thank you so much for turning up today. We had a lot of fun with the Brexit and obviously the England game for those who were interested last night. For those of you who may not have seen me before I present, I try and keep my presentations very technical. Every so often I will be giving a viewpoint that's either Kuber's or my own personal, at which point I'll put my hand in the air, the happy hand of Kuber and Sean Burrows here, and at which point you know that some guy's selling to you. So a lot of technical details. Every so often I'm going to go off on one to sell. What we've tried to do here is to combine technical with a presentation from managers that are linked into the technical ideas. The technical ideas, I think one of them is pretty far out there in terms of planning, but I think it's a phenomenally good idea for both capital gains tax and also for entrepreneurially, but I'll come on to that a bit later. So really wanted to sort of kick off with an alternative to pension. I've got a little presentation here, but if it's okay, if I come back to where I started on looking at pensions as an alternative using EISs. This was a conversation that IFA phoned me up on a Saturday morning back in February time, saying he was skiing with his brother-in-law and he was drunk. I appreciated this on so many levels, this particular conversation, but he was saying that his brother-in-law was on a salary of 200,000. The company that he has been working for were putting in 40,000 into his pension, but because the guy's on 200,000, they were going to restrict the contribution level into his pension down to £10,000 in April. And he was saying his brother-in-law was not particularly happy about it. And I was thinking, well, okay, well, what possible solutions are there for an alternative there? And I said, look, do you think the company would be happy to pay the 40,000 if they could pay it into another type of investment vehicle? And he said, yeah, it could well be. So we looked at that and said, well, okay, what are the implications? So if they're happy to pay that 40,000, the problem is if they pay it into an EIS for him, it would be considered a remuneration. So at the moment, he's going to have 10,000 being paid in. I asked, the client was above the lifetime allowance, so actually there's a potentially 55% tax charge on that. So that 10,000 actually represents around 4,500. So we go back to the 40,000. If the company wants to put 40,000 into an EIS, we need to take into account company NI, so that's 13.8%, so roughly 35,000. We then look at the employees' tax and NI, so 45% tax, 2% NI. That brings us down to roughly about 18,000. On that 18,000 contribution, he can get 30% tax relief if he's doing it through EIS. So that's what, 5,000–6,000 or so? So I'll put that with a happy hand up here. So we then looked at that and said, well, actually, let's kind of look at the worst case scenario in that situation. So, well, okay, if we've had that relief, so 18,000, we've had £5,000–6,000 worth of income tax relief. If that investment did atrociously badly and went down to zero, so nothing that could ever happen to any of the two managers here and their products and services that they're providing, so that would mean that we'd have about 12,000 and you get loss relief on that. So that loss relief would be at 45%, so it would be roughly 5,000–6,000. So we've gone from having 5,000–6,000 here, we've got 5,000–6,000 here. Worst case scenario is that he will get 10,000–12,000. That's the absolute worst case scenario against what is 4,500 over here. And I was thinking, well, that just is insane. That just makes perfect sense for a company to do that. And one of my colleagues, Russell, has done a group scheme recently and done that for a company where a whole board of directors and a number of senior management people, and they've done a quarterly scheme, so they're just going to pay in quarterly for those members of staff as an alternative. But then it got me thinking, you know, like when you sit back, sorry, I used to be an IFA, so I always like to sense check these things, you know, sort of, you know, if I was in that scenario, would I do it? And I always think of it as, well, what is going to be my experience if that was me as an employee? My experience would be that I'll be having a big net tax deduction off my payslip. So if I'm happy with that, fine, not a problem at all. When am I going to get the tax relief back? Well, in regular premium EISs, you've got to be thinking it's going to have a few months before it's accumulated enough when a manager's going to have a closing. And then, you know, depending on which sector you're looking at, media potentially shorter, if you looked at, say, renewables, potentially longer. So you could be a year to 18 months before you start receiving EIS 3 certifications back for that, so to have the net tax effect. Some people will say, yeah, no problems. Other people, well, let's face it, do we all work to our income? You know, do we all spend our income? And it doesn't matter what level that income gets to, we always find a unique way of spending it. So just keep in mind that actually that might be the net effect. And I was thinking, well, what would I potentially do in that scenario? I'd probably turn around and ask the company for the extra 40,000 and just take that as salary and sign off saying they don't make any pension contribution for me, because any additional pension contributions at that point with a potential 55% tax charge just isn't worthwhile. But what would I do? I'd probably do a lump sum into an EIS of 20 to 30,000 as a lump sum, any time between now and October. And the reason for that sort of timescale is there's this whole thing about, in an ideal world, we'd want to hit, for any person investing into an EIS, 30 individual investments. If we look at an average closing of an EIS manager, they close with anywhere on average between 2 to 8 investments, as a rough rule of thumb. So I was thinking, okay, if we had 30,000, what does Kuber do? Well, we allow you to invest into any of our managers at the level of 5,000 with inside EISs. So 30,000 will give you a chance to go into 6 managers. Take, again, worst case scenario, sorry about this, I used to be a compliance officer, you can give me a kicking later. 2 investments on that, that's 12 investments. But then what would we do about it? Well, we would probably say, actually, if you tell us that the reason you're doing it is for income tax, we may split that, so that 5,000 that's going to a manager, split it over 2 closings. So if we know that by the end of October, when you give us the funds, that manager's going to have a couple of closings, we'll split it across. The net effect for the client is, oh, why is it all my money going in as sooner as possible? The great thing is that will then double you up on potentially the amount of holdings. That again, worst case scenario, that brings you to 24 different holdings, which actually, when we're looking at that magical number of 30 investments, which if you look at any investments within the EISs over the last 10 years, any portfolio of 30, you will have some that will do awfully, some that will do pretty well, and some that will do phenomenally well, and you'll get a decent investment return. So that's why we always have this thing, diversification of 30 investments. Does that kind of make sense where I think it's coming from? I don't think that it's necessarily a bad thing to do the regular premiums. I think it's really good. One thing I would say, as a personal viewpoint, is if you're going to do that, for regular premiums, there's probably going to be a lot of EIS 3 certificates flying around. And what I would probably suggest is our system allows you to set those up to be sent directly to the client's accountant. Going back to my iPhone base, that would be what I would tick. Because the great thing about the Kuber portal is the Kuber portal, all correspondence we receive, including copies of EIS 3 certificates, are immediately loaded onto the portal and you have access to them. You can also set your client up with access to them so they can have a look at the system. And if you really want, we can even get the accountants to have access to that system as well so they can see the information. So again, make your life really simple, really straightforward. Okay. So, I'll start my presentation now. Alternatives to pensions. So, just really want to look at some of the issues facing clients that are going into pensions. There was this great article by the PFS a few months ago saying that actually you could be on a salary of 90,000 and still bust the 150,000 earnings cap for contribution levels based on other benefits in kind. So it's kind of, when we always talk about really high net worth, actually it could be at a lower level than that to restrict your maximum contribution down to 10,000. Lifetime allowances are being restricted. There's a very interesting conversation that's been going on for the last 2 years with the revenue is over final salary pension schemes. Now, since I used to have long flowing hair and was slim, the revaluation of final salary schemes has been 20 times. If you look at that 20 times number compared to transfer values, there is a massive disparity between those two numbers. And the revenue has been looking at changing it to a current transfer value over lifetime allowances. If that happens, I reckon we're going to have a whole chunk of society that are suddenly going to be overfunded on a lifetime basis. So again, when you're starting to think of, well, next contribution, should I do the next contribution of lump sum into a pension, or should I look at some alternatives? That might come into your thought process. Accessibility. EISs are illiquid investments. They tend to run anywhere really from about 3.5 years to up to around about 6.5 years, depending on the manager and style that you're looking for. But then again, if we're comparing it to a pension contribution, pensions aren't flexible enough to access really before the age of 55, unless you're a jockey or something like that. As you can tell by my shape, I'm obviously a former jockey. But you think about it and think about, well, okay, I want to tie up my client's funds for a period of time. Do you think they're going to be happy with it? Well, yeah, potentially, if they're comparing it to a pension, because that's the experience they would have under a pension scheme. And don't forget, we're also talking about a scheme that provides tax relief. IHT, this is an interesting one, because there are lots of wrinkles around inheritance tax inside an EIS investment and the SEIS, especially thinking about some clients who potentially have early stage or could die early on inside the investments. And there's lots of really interesting bits of planning that you can do, which unfortunately I don't have time to talk about now, but come grab me if that's the sort of market you're in a bit later on. But actually, the pension regime is designed to pay out an income stream really to beneficiary under a taxation basis. What does an EIS do? Well, an EIS, if it matures, is considered to be IHT free until that point of maturing after 2 years. But with our platform, what would you do with a maturing EIS? Well, if you don't need the income tax relief to reinvest again, you drop it across into business property relief. Keep that IHT relief running on it. You have a 3-year window from when an EIS matures to put it into another BPRable vehicle like EIS, AIM or BPR as a standalone arrangement, and you look at that and think, okay, I've got that 3-year window, if I put that back in, it's immediately free of inheritance tax. Oh, and by the way, sorry, on Kuber, you have a maturing EIS coming out and you put it across into BPR. We've charged you initially to go onto the platform, and the vast majority of our EIS managers pay a rebate. When you move it across into BPR or you move it into another EIS or an SEIS, there's another rebate. We don't charge again. You know, we don't charge that other 1.5% that we charge. You're already on our platform. So you're thinking from an advisory point of view, you're at an advice point, you're looking to make a charge for that advice. Well, actually, there's a chunk of money coming back to the client in terms of rebates. So, you can have a look at Bob. So, yeah, always excuse my names, I always use family members so that I can follow the flow of these things. So, Bob is 50, he's got 15 years to retire, he's looking to retire at 65. Got a couple of kids, got an IHT problem, looking to put away around about £2,500 a month. So I picked a online pensions calculator through a IFA practice based down in Bristol with initials HL, which I can't tell you the name of that, and assumed 5%, so mid-range growth rate, 5% growth per annum, 1% annual management charge. So in olden terms, tax-free cash of 125,000, residual taxable pension of 375,000. Interestingly, and this is probably a number I want you to remember, is on that, even though we had 40% relief on the contribution, the tax relief on this was 180,000. So I tend to work in simple terms. We've got around about 300,000, just over 300,000 that's tax-free, just shy of 400,000, which is going to be taxable as a pension. So, I looked at doing a similar type of investment, so but through an EIS, so 2,500 into an EIS. Our minimum per manager into an EIS is £500, so that would allow you access to 5 managers. Again, what I look at this and say, actually, if I was going to put 2,500 a month in, I'd probably pick one manager until we have a closing. When that manager closes and takes the funds, then I can redirect into another manager. We have flexibility on our platform. It's an online service, so you have that complete flexibility and autonomy to do that. But in this circumstances, I looked at 5 managers who are asset-backed, which Martin's going to talk particularly about one of the asset-backed, well, 2 of the asset-backed solutions that his company provides. And I took into account all of our charges, and what I looked at was some of these EISs matured 3.5 years, some of them were around 6 years. The average was coming out around 4.5, but I thought, well, let's round it up to 5 years. So maturing EIS is coming out every 5 years as such, and when they mature out, they go back in. Okay? One of the really cool things about EISs and SEIS is when you go back in, you get another round of tax rebates. And if you said about, say, the higher risk things that we're going to talk about a bit later on, CDISs, that's 50% income tax rebate. So if you've got a CDIS which is designed around 5-year window, if it just returns the original investment, well, 5 years you've had all of your money back in terms of tax rebates. That's kind of sexy. And I realise I'm a bit nerdish saying sexy, but go with me on this. So, we're going to look at Bob. So what does Bob get? Well, if we look at it and say his first year's contribution comes out in year 5, reinvested, he's still putting in regulars, it'll come out in year 10, year 15. So at year 15, so when Bob hits 65, he'll get a tax-free lump sum for both income and capital gains tax of 139,000. That's repeated each year. Okay, let's think about client scenario in this situation. Most clients, when they come to retire, if they've got just money purchase schemes, they're probably not going to take much from their pensions initially. You know, they might take the tax-free lump sum, so they could be going from quite a high income tax position to, in the early stages of retirement, not paying much in the way of income tax. They've got capital, they're quite happy to live on that. So this first 139,000, what's likely to happen to it? It's probably going to come in just paying no tax, so they're not likely to reinvest it into an EIS. They can probably put it across into business property with it. Probably the same for the first couple of years. Let's say we get to 68. At 68, we have a position where the client takes out a big drawdown on his pension and say triggers £30,000 worth of tax. But at that point, what we would do is probably take 100,000 of the 139 maturing, put it into EIS, wipe out that tax charge, the other 39 would drop into business property relief. Yeah? Or let's say it's past that, all of the funds went into BPR, and Bob's now 72, takes a big chunk out of his pension. We're just going to move funds from BPR across into EIS. Each time you're getting rebates, you know, generally speaking, from most managers. So you're going to get accumulation up, and you're becoming a managed portfolio on the platform. I always like the expression funds under influence. I don't know if you've ever come across that. When people invest into an EIS or a BPR arrangement or a seed EIS, a lot of people, when they come in to potentially sell their business, look at it as a product solution with a finite period, and therefore won't count it into a valuation. Funds on a platform feel like funds under influence because, you know, doesn't flow off platforms as much as it does from maturing products. So again, keep that funds under influence always by using a platform in that scenario. So, do you remember we were saying about 300,000 tax-free, about just shy of 400,000 taxable on the pension? What do we get from Bob from an EIS? Well, we get just shy of 700,000 completely tax-free. Oh, also, it's IHT free. Okay, it's IHT free as long as you keep it in that IHT vehicle. Remember, an EIS maturing matures back into an IHT position, but you have that 3-year window to get it back out. So that's a lot of tax-free investments. So when you start thinking about, well, what do I want? And I was thinking about, sorry, I'll go back quite a few years, and I was thinking when I first got involved in financial services, endowment mortgages were the thing to be sold. And I was thinking to a lot of my clients, because the interest rates were going up high, I was talking to them a lot about doing repayment or doing a mixture of both. And I was thinking actually, a mixture of both methodology or bringing in different investment media makes a lot of sense. And practically all of our clients around this table will have pension schemes. Not all of them will have EISs. And I think it's a good thing to think about blending an approach to the client's retirement needs. So, just in summary, it's a good alternative option to what's becoming a more restrictive pension regime. I keep thinking sort of potentially our younger clients may not even have pensions going forward. They're talking about a similar scheme to America, to have a slightly boosted ISA arrangement. But if you're not going to get tax relief going into it, this still kicks in as a really good alternative for those. For our clients who are high net worth in their 50s through to their sort of, 60s as such, I think a lot of them will be overfunded in pensions, or those that actually will want different type of investment media. They like the idea of investing into individual companies, and I think that's where EIS really kicks in. Potentially higher income tax relief because in total, if we go back a few slides, the income tax rebate for Bob was 240,000. Do you remember we were saying, because that's at a 30% rate. On the pension, it was what, 180,000, and that was at 40%. But this is again about getting tax relief on top of tax relief when you have maturing funds going back in. So, it's IHT efficient past 65, which is really useful. And also, don't forget, you've still got CGT deferment on there. If you do an investment with inside an EIS, you can use CGT up to 1 year forward or 3 years back. Okay, and we'll talk about a really little slick CGT idea a bit later on. And as I always like to have this in my slides, a real holistic idea about planning. Because I think it brings together what we talk about in terms of pension planning and what we bring as added values as advisors to those type of clients. Always like the stunned looks on their faces. Has anybody got any questions at all before I pass over to Martin? At all? No? Brilliant. Okay, I'd like to introduce you to Martin Sherwood of Enterprise. Martin is a phenomenally good speaker, so I'm really looking forward to this morning's session. I'm going to talk about 2 of the investments that he has under the platform. Thank you. It's just that.